Hi pension subscribers and welcome back to the channel. For those of you who know me, my name is Dominic James Murray, CEO and founder here at Cameron James. Okay, today the topic is how do interest rates affect inflation? So we're currently in a period of time where central banks, the Federal Reserve and the Bank of England is raising interest rates in order to try to curb current inflation. So how does it work? Well, it's pretty simple economics. As you raise interest rates, the cost of borrowing is also increased, which then means that people have less money, so that people buy less product or less goods, which then means the pressure on those goods falls, and so inflation falls. Obviously, in the opposite situation, you have the opposite effect. So at the moment, when we have Jerome Powell obviously doing many interviews at the moment, talking about interest rates, effectively what they're saying is we will be continuing to raise interest rates in order to try and bring inflation down. Now, unfortunately, raising interest rates or decreasing interest rates is one of the biggest economic levers that the government have. However, it typically takes around 12 months' time when they start pulling that economic lever for them to see the impact on inflation. However, when they pull that economic lever, particularly in the markets that we currently work in, the stock markets and the equity markets will react instantaneously to that information. So, for example, when Jerome Powell made his 8-minute speech recently talking about how he expects to continue raising interest rates, I think it was something ridiculous out of Elon Musk, Jeff Bezos and a couple more. I think they had about 50 billion wiped off their asset value in the space of that 8-minute meeting. Now, really, what has happened over the course of that 8 minutes? Have those companies changed? Have their products changed? Are they still shipping Teslas or not? Yes, none of that has changed. All that's changed is people's perception of the financial markets. And now we live in a world, unfortunately, where financial markets go up on a whim, they overshoot and they undershoot based on information which comes out. So for anyone with a final salary pension scheme at the moment, or for anyone who's getting their CETVs, you will know from 2022 that CETV values have been decreasing. I had clients at the start of the year, then we got a second CETV, some of them even got a third CETV because they didn't take the plunge on the second CETV, and obviously they've dropped over that period of time. The reason for this, as I've said before in many of our videos, is there is an inverse relationship between interest rates and CETV values. Now, the thing that sits in between interest rates and CETV values is actually gilt rates. Schemes in the UK, your DB scheme doesn't go and take the interest rate from the Bank of England or the Fed and say, okay, that's how we're going to work out your CETV. Typically speaking, in the United Kingdom, they will use the 10-year or the 20-year gilt rate. Now, a lot of people will say to me, okay, we've just seen interest rates gone from, when we went from 1.25 to 1.75% in the UK, which I think was the largest increase in 27 years, I believe, off the top of my head. Effectively, clients say, oh God, well, my CETV wasn't calculated by that date, so now it's all going to be terrible. Well, actually, it doesn't quite work like that. The 10-year gilt rate and the 20-year gilt rate already factors in information from the market. They factor in recessions. They factor in the fact that the Fed have quite clearly gone on record to say that they will be raising interest rates. So it's not like suddenly on the day of that happening, they then say, okay, the 10-year gilt rate will go absolutely mad. No. Because the 10-year gilt rate, all the traders who are trading that have already factored in that there will already be interest rates coming in the near future. So they ensure to obviously factor that in as well. So we don't necessarily see a direct impact straight away. So in terms of CETVs, what I can say to people is over the course of 2022 and possibly into 2023, possibly even 2024, we do not see things getting better. We do not see a situation where they're going to start to decrease interest rates, which would mean that your CETV value is going to go back up. As such, for anyone who has a CETV right now, if you have a guaranteed CETV and you're sitting on it right now, what I can almost certainly say to you is if you let that one expire and then you get a new guaranteed CETV in 3 months or 6 months time, invariably it's probably going to be lower than what you've been offered now. Now, as I should state very clearly, your CETV value in itself does not affect the suitability of your pension transfer. Any good or qualified pension transfer specialist won't transfer your pension or will not transfer your pension because of what the CETV value is. It doesn't work like that. It's down to your situation. Is it suitable for you to move away from a safeguarded asset? What benefits would you have? What other assets do you have? Who relies on you? Are you married? Are you not married? Do you have dependents? There's many factors. What is your plan? Do you have sufficient money for retirement, etc., etc.? There's many factors that are actually more important than a CETV value, but I do understand that as clients, you see the figure and you say, am I getting a good deal or am I getting a bad deal? That means I should transfer out and I shouldn't transfer out. Part of this is correct. Obviously, the higher amount you start your SIP with, the better. However, if you start your SIP with say 500 grand, or you start your SIP with 400 grand, whatever it might be, over the course of 5, 10, 15, 20 years worth of equity market growth, the most important thing is if you think you should be outside your DB scheme, for example, you want to take more risk than your DB scheme, you think you can outperform your DB scheme, which might be growing at 3 or 4% guaranteed per annum. If you think of a balanced or adventurous portfolio, 65, 80% equity weightings, that you can achieve 8, 9, 10% growth per annum, which obviously is very achievable, that should not hold you back from then saying, okay, well, I'm going to keep my lower CETV in that scheme of a lower growth rate, potentially lower growth rate, and not do a transfer now because my CETV has gone down. That's not really how you should be thinking. And if you speak to a qualified pension transfer specialist like myself, which you can do by booking in below in the description, have a conversation, get all this information out to them. We've got a lot of clients at the moment who are trying to sit at home, do all this, time all this information. They have jobs as well, they have families, they have dogs, they have pets, they have whatever they have going on in their lives. We sit and do this 10 hours a day. If you want to ask us questions, do you think my CETV value is going to go up or down? We can talk to you about it. We can't give you, it's not financial advice to say whether your CETV value is going to go up or down. We don't charge for that. The only thing we charge for is when people actually go through an authorized DB advice process. So what I would say to people is get in touch. Don't sit at home, don't try and time the market yourself. Understand what's happening by talking to a qualified specialist. Doesn't mean to say that you're going to start a pension transfer, you're going to start an advice process, but educate yourself correctly rather than trying to do it independently. A lot of clients at the moment, even clients I spoke with 3 or 4 weeks ago, I said to them, whatever you do, when you get off a telephone call today, they say, oh, I'm not ready to do a fact find yet, I'm not ready to complete a letter of authority with you. I say, that's absolutely fine. I understand that psychologically you think by doing a fact find with us, you're already working with us. Well, you're not. There's still many rounds of paperwork which need to go. The fact find is really just our due diligence process to show to our regulators that we're doing the correct job and taking down the correct information. But I say to them on the call, get off the phone today and request a new CETV. They say, yeah, but Dominic, it's going to cost me another £250. I'm like, your CETV is $500,000, you know? If I had a $500,000 CETV and you were trying to time your CETV, I'd be getting a new one every 3 months. 250 quid. It's nothing in comparison to £500,000, which could go up by tens of thousands of pounds or drop by tens of thousands of pounds. But invariably, you speak to them 2 weeks later, oh, how'd you get on with getting your CETV? Oh, I didn't do it. Why? Oh, well, I'm still thinking about it. And I'm like, okay, well, whilst you've done that, the gilt rates, 10-year and 20-year gilt rates have gone up from maybe 1.8 to 2%. So your CETV value might have gone down by 20, 30, 50 grand over that period of time. But hey, you saved 250 quid, so great for you. So not that I'm trying to take the piss out of clients here, because I understand that it's quite complicated for you, but listen to professionals. Get your CETVs, get a guaranteed CETV. What you see on your portal, an estimated CETV, it's worthless. You cannot transfer it. It's not legally, they're not legally obliged to transfer you that amount. The only thing that matters is a guaranteed CETV. Guys, I hope it's been valuable. Please like, subscribe, and share the channel to let us know that our content is valuable for you. Thank you very much.